All right, pause the scroll for a second and lean in, because something genuinely unusual just happened in the silver market, and it happened fast. If you watch commodities, if you watch currencies, or honestly, if you just care about how stress shows up in the global system, this matters to you. In the last couple of hours, silver ripped through $121 an ounce in Western markets, while at the exact same time, China started trading the same metal north of $139 spot, and as high as $146.17 in futures. That's not a typo. That's a 26 plus gap on the same asset, same moment, different world. Stay with me, because I'm going to show you why this isn't just a price spike. It's a signal, and how you can spot these signals before they show up on everyone's feed. If you're watching this now, you're ahead of the conversation that's about to dominate financial media for the next week. Your job is to understand what's actually happening underneath the headlines, not just react to the price. Now, before I explain what caused this, let me slow it down and teach you something most people never really internalize. There isn't one silver market. There are layers. There's the paper market, where contracts trade and most headlines are made. And then there's the physical market, where actual bars have to be mined, refined, shipped, and delivered. Think of it like airline tickets versus actual seats on the plane. As long as no one asks to board, prices look calm. Everyone's happy. The moment everyone shows up at the gate demanding their seat, reality hits. When physical demand overwhelms available supply, prices don't move smoothly. They snap. And the first place you see that snap is in premiums, spreads, and regional price gaps, not in the headline number everyone quotes on the evening news. So what does that tell us? It tells us that the official price you see on your screen is often the last thing to reflect reality. The stress shows up first in the mechanics, in the plumbing of the market, in the places most people aren't watching. If this is making sense, drop a comment below and let me know if you've been tracking these physical premiums, because that's where the real education happens. Now here's what's actually happening. Let me break down the sequence because this is where the story gets real. Primary driver first. Physical supply is tight, globally tight, not we might run low someday, tight. Major refiners like Perth Mint and Metalor have halted or restricted new orders because they can't source enough feedstock without blowing out delivery timelines. That's not speculation, that's operational stress. When a major refiner tells you they can't take your order, that's not a pricing problem, that's a supply problem. And here's the chain reaction. When refiners can't get feedstock, they can't produce bars. When they can't produce bars, dealers can't fulfill orders. When dealers can't fulfill orders, premiums explode. And when premiums explode, that's your early warning system screaming at you that something's broken in the supply chain. You're watching it happen in real time. Secondary confirmation comes from inventories. Vault stocks are draining, not rotating, draining. There's a difference. Rotation means metal moves in and out as people trade. Draining means metal leaves and doesn't come back. When you see registered inventory at COMEX dropping week after week, when you see eligible inventory sitting there but not moving into registered status, that's confirmation. The metal that's available isn't being offered at current prices, and that tells you the people who own that metal think prices are going higher, or they need it for something else, or both. And then comes the convergence proof, China. On the Shanghai Futures Exchange, silver isn't just trading higher, it's screaming higher. That $18 to $26 premium over Western spot tells you physical metal inside China is being bid aggressively, regardless of what Western paper markets say. And here's what makes this significant. China's not a small player. They're a major industrial consumer and increasingly a major investment destination for precious metals. When their market decouples from Western pricing by this magnitude, you're not looking at noise. You're looking at structural divergence. But here's the part that should make you nervous. When physical markets decouple like this, the paper price stops being a price and starts being a suggestion. And suggestions don't clear shortages. They don't deliver metal, they don't satisfy industrial demand. What clears shortages is higher prices, much higher prices, until supply and demand actually meet. Now zoom out for a second, because this isn't random. This is the exact same playbook we've seen before, just with modern scale and modern speed. In the late 1970s and into that 1980 spike, silver didn't move because of hype alone. It moved because supply constraints met monetary stress and industrial demand at the same time. You had inflation running hot, you had currency concerns, and you had industrial users scrambling for metal. Fast forward to the early 2000s commodities supercycle. Same pattern. Tight inventories, rising investment demand from both individuals and institutions, and a slow response from supply because you can't just turn on a silver mine overnight. Every time this happens, the early signal is physical premiums blowing out before the public notices the price. When everyone's talking about it on social media, you're late. When premiums are spiking and nobody's covering it, you're early. And then there's 2011. Remember that move? Silver went from $18 to nearly $50 in less than a year. What preceded it? declining COMEX inventories, rising premiums on physical coins and bars, and a disconnect between what paper traders thought silver was worth and what physical buyers were willing to pay. Ring any bells? When you zoom out, the larger story is simple but uncomfortable. Silver's been in a structural deficit for years, meaning more silver is being consumed industrially than is being mined. And early 2026 is when the math finally stopped working. The buffer that existed, that cushion of above-ground inventory, it's thin now, really thin. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this reverse? Of course. Markets don't move in straight lines. Margin requirements can be raised, and that'll force leverage players out and crash prices temporarily. Interventions can happen. We've seen it before. Speculative froth can shake weak hands out, and there's always weak hands in a bull market. And yes, there's always talk of manipulation, of suppression, of conspiracies. Here's the thing, though. It doesn't actually matter whether there's some grand plan or not. You don't need to solve conspiracies to understand stress. You just watch deliveries, premiums, and spreads. Focus on what you can control. Data over drama, mechanics over narratives. Can prices pull back 20%, 30% from here? Absolutely. Will that change the fundamental supply deficit? Probably not. So the question isn't whether volatility happens. It's whether the underlying structure has changed. There are probably three types of people watching this right now. If you're already holding silver, whether you bought it at $18 or $80 or somewhere in between, you're probably feeling validated and a little uneasy at the same time. That's normal. Your job isn't to celebrate price, it's to monitor risk. Watch volatility. Watch margin changes if you're holding futures or levered products, and don't confuse a bull market with invincibility. Bull markets hurt people too, just in different ways. They hurt people who get greedy, who over-leverage, who assume the move continues forever. So stay disciplined, have a plan, know where you'd take some risk off the table, not out of fear but out of strategy. If you're on the sidelines thinking you missed it, let me be honest with you. Chasing vertical moves is how people get hurt. If silver's up 60% in 2 weeks and you're just hearing about it now, buying at the top of that spike is not the move. Your edge is patience and understanding structure, not emotion. What you should be doing right now is learning. Watch how this unfolds. Watch what happens when prices get extended. Watch how corrections work. Watch how premiums behave. Because there will be another entry point. There always is. And when it comes, you'll actually know what you're looking at instead of just reacting. And if you're a skeptic who thinks this is just another commodity spike that'll fade like all the others, I get it. Healthy skepticism keeps you solvent. But your homework is to watch the physical signals. Premiums don't lie for long. If you see premiums stay elevated even after prices pull back, that's telling you something. If you see delivery volumes staying high, if you see refiner constraints continuing, that's data. You don't have to believe me. You don't have to believe anyone. Just watch the data. The universal principle for all of you, regardless of where you stand, is this. Price is the last thing to move. Structure moves first. The people who profit aren't the ones chasing headlines. They're the ones watching the mechanics change before the headlines even exist. So here's what I want you to answer in the comments. Where are you right now? Are you holding and trying to manage the ride? Are you waiting for clarity? Or are you learning the patterns for next time? I'm genuinely curious because understanding where you are helps me create better content for you. So here's where I stand. I'm not euphoric and I'm not dismissive. I'm alert. Let me tell you what I'm personally watching. First, I'm watching backwardation spreads. If near-term contracts are trading higher than future contracts, that tells you immediate demand overwhelms future supply expectations. That's stress. Second, I'm watching delivery volumes, especially in Asia. COMEX delivery notices matter, but what's happening in Shanghai and Hong Kong matters more right now because that's where the physical stress is showing up first. If those volumes stay elevated or increase, that confirms this isn't just speculative, it's real demand. Third, I'm monitoring physical premiums relative to paper price. That gap is the heartbeat of this entire story. If that gap widens, you know the divergence is getting worse. If it narrows, you know either supply improved or demand cooled. Based on my analysis, this move was mechanical and structural, not just technical or speculative. The fundamental picture around silver supply hasn't changed overnight. The deficit is real. The industrial demand from solar, from electronics, from EVs, that's not going away. The investment demand that's starting to wake up, that's real too. And the supply response, it's slow. This isn't oil where you can turn valves. This is mining. You need years to bring new supply online. So the gap between demand and supply, it's not closing fast. If history rhymes and silver continues to find physical demand at these elevated levels, the move that follows could make this look like the warm-up. I'm not predicting it. I'm saying the conditions exist for it. Now, I'm not a financial advisor. This is not financial advice. I'm a market observer sharing what I'm watching and how I'm thinking about it. Do your own research. Make your own decisions. Don't follow anyone blindly, including me. If you made it this far, you're the kind of person who actually wants to understand markets, not just react to them. That mentality will serve you well. This isn't about getting rich quick. It's about understanding how these systems work, so when opportunities present themselves, you recognize them. Share this with someone who's asking questions about silver right now. Subscribe if you want more breakdowns like this when these patterns emerge, and stay ahead of the noise. This move wasn't random. It was mechanical. It was structural. And if history rhymes, this isn't the end of the conversation. It's the beginning of a much louder one. Stay sharp out there. Verify the data. Think critically, and make your decisions with your eyes open.